Something is deeply wrong with this market. Not wrong in the way headlines describe it, not wrong in the way your broker explains it, not wrong in the way financial television frames it every single morning, wrong in the way that only shows up when you stop listening and start looking at the raw data yourself. Wrong in the way that history records after the fact, when everyone finally admits they should have seen it coming. Wrong in the way that separates the people who understood the signal from the people who only read the headline. Wrong in a way that markets whisper before they scream. Wrong in a way that the options market, the one instrument that doesn't lie, is now screaming louder at $74 silver than it ever did at $121. Let that land for a second. Silver was trading above $121 just 3 weeks ago. It was the talk of every financial channel, every metals forum, every trading desk that follows this market. Analysts were scrambling to revise their price targets upward. Retail investors were flooding into SLV. The narrative was momentum, breakout, historic move. And the implied volatility on CME silver options at that moment? Elevated? Sure, but nothing extraordinary. Nothing that made veteran options traders stop mid-sentence and say something is structurally broken here. Fast forward to today. Silver is at $74, a 40% collapse from peak. The mainstream headline writes itself. Bull market over, metal crashes, bubble deflates, investors flee. That's the story they want you to absorb, file away, and stop thinking about. But here is what they are not telling you. The 30-day implied volatility on CME silver options right now, today, at $74, is more than 10 full points higher than it was when silver was trading at its all-time high above $121. Read that one more time and let the strangeness of it fully register. The options market, the instrument that professional traders use to price future risk and expected price movement, is saying that silver at $74 carries more explosive potential than silver did at the all-time high. That is not a normal signal. That is not routine volatility fluctuation after a price correction. That is the market equivalent of a seismograph spiking harder after the earthquake than during it. Something beneath the surface has not resolved. Something beneath the surface may have gotten worse. Implied volatility doesn't spike in a vacuum. It spikes because sophisticated capital, institutional desks, derivatives traders who run quantitative models built on decades of market data, are pricing in the probability of a violent move. They don't know which direction. That's not how implied volatility works. But they are collectively agreeing, through billions of dollars of options premium, that the range of outcomes from this price level is wider and more explosive than it was when silver was at its all-time peak. That agreement costs real money to express. These are not retail traders clicking buttons on a phone app. This is informed capital screaming that the story is not finished. Now add the second layer. Convexity and skew spiked simultaneously. In options analysis, when implied volatility rises alone, it means the market expects a big move, but the direction is genuinely uncertain. When skew spikes alongside it, it means the market is pricing asymmetric outcomes. One direction is being hedged more aggressively than the other. When both convexity and skew move together in the same window, derivatives professionals call it a coordinated signal. It means multiple types of sophisticated positioning are converging on the same conclusion from different analytical approaches. This does not happen by accident. This does not happen from retail noise. This is institutional intelligence expressing itself through the only instrument that cannot be easily manipulated with paper contracts, the options market itself. And yet the financial media is focused entirely on the 40% decline in spot price. That's the wall they build. Ridicule and noise on one side, data on the other. They have spent decades and billions of dollars training you to look at spot price and conclude the story. Because if you looked at the full picture, the questions you would start asking would be deeply uncomfortable for the institutions running this system. Let's talk about what else is happening simultaneously, because implied volatility doesn't exist in a sterile laboratory. It exists inside a specific market structure, and that structure right now is unlike anything seen in modern silver trading history. 8 trading days remain until first notice day on February 27th. That's the date when physical delivery begins against open futures contracts. March silver open interest currently sits at 58,170 contracts. That represents 294 million ounces of paper silver obligated for potential delivery. Now here is what makes experienced commodity traders go quiet when they look at this number. There has been no mass roll, no panic unwind, no normal institutional behavior where large players systematically move their positions to deferred months as the delivery deadline approaches. The open interest is sitting essentially unmoved with the clock running hard. In normal market cycles, open interest at this stage, this close to first notice day, would already be compressing as funds rotate out of the front month. It's not happening. Either those holding these contracts are genuinely prepared for physical delivery at scale, or someone is deliberately holding to apply maximum pressure at the deadline, or certain large players have arrangements already in place that make the delivery mechanism less relevant to their position management. Any one of these explanations changes the entire narrative around this price decline. All three together, simultaneously plausible, simultaneously unresolved, create the conditions that make experienced options traders start buying volatility at levels not seen relative to spot price in this market's recorded history. Now shift your attention to the geographic dimension of this situation, because this is where the story becomes truly extraordinary. Western spot silver is trading at $74. Shanghai physical silver, on a different exchange in a different hemisphere, is currently trading at $86 spot, with futures at $88. A $12 premium of Eastern physical over Western paper, holding firm even as the Western paper price collapses. But that East-West spread, while significant, is not the most alarming number coming out of the Shanghai market right now. The truly alarming number is this. Shanghai physical silver is trading at nearly a 20% premium above the paper derivative contract, on the same exchange, in the same city, denominated in the same currency. This is not East versus West. This is physical silver versus paper silver on a single exchange in Shanghai, and the physical is trading 20% above the paper. That number describes a shortage so acute that sophisticated Asian buyers are paying a 20% premium on their own domestic exchange rather than trust the paper contract to deliver the metal they need. When that happens, when physical buyers in a major market pay 20% over paper price rather than route through the paper mechanism, it means the paper mechanism has lost credibility as a delivery vehicle for the actual physical metal. That data is publicly available through exchange reporting. You don't need a subscription. You don't need an institutional terminal. You need 15 minutes and the willingness to look at primary sources rather than accepting someone else's summary of what markets are doing. Meanwhile, industrial buyers are reportedly routing around the exchange system entirely. Mine executives are fielding direct inquiries from manufacturers wanting guaranteed physical delivery at premiums, reportedly reaching at 20% above spot for guaranteed supply. Samsung reportedly already executed this type of direct arrangement. When companies whose production lines depend on physical silver stop trusting the established market mechanism, they don't file complaints with regulators. They build parallel infrastructure. And that parallel infrastructure sets price based on actual physical scarcity, not paper contracts. This matters for the implied volatility signal in a very specific way. If industrial buyers are routing around the exchange in growing volume, the visible price on the exchange increasingly reflects only the paper market participants. Hedge funds taking speculative short positions, banks running derivatives, books, algorithms chasing momentum. The physical buyers, the ones with genuine demand for the actual metal, are disappearing from the visible price discovery mechanism. When physical demand stops anchoring the paper market, paper price can move further in both directions than fundamental analysis would predict. That's what implied volatility is pricing. The paper market, untethered from physical reality, is capable of violent moves in either direction. The options market knows this. That's why volatility surges past previous peaks, even as spot price collapses. Now bring in the macro context, because silver's options market doesn't exist in isolation from the broader financial system. And the broader financial system right now is sending signals that should command serious attention. U.S. national debt is officially projected to surge $2.4 trillion per year over the next decade. Total debt reaching $64 trillion by 2036. Double current levels, triple pre-pandemic levels. Annual interest costs alone projected to double to $2.1 trillion. These are not fringe estimates from alternative analysts. These are the government's own budget projections from primary source documents. And critically, those projections assume zero recession across the entire 10-year period. Not 1 quarter of negative growth. Zero. In an economy where housing affordability is at the worst level since 2008. In an environment where big tech credit default swaps outstanding jumped nearly 400% in just 13 months. From $2.2 billion to $10 billion. A year ago, CDS contracts pricing default risk on major technology names essentially didn't exist. Now institutional desks are paying real premium to hedge that risk at scale. That is not a signal that sophisticated capital believes the AI-driven debt expansion across the technology sector is sustainable.